Ever wondered how businesses keep track of every penny they earn and spend? Or how companies make critical financial decisions with confidence? It all starts with one key skill, accounting. But wait, accounting isn't just about crunching numbers. It's a language, and just like any language, it has its own terms and principles. If you've ever felt lost in a conversation about assets, liabilities, or balance sheets, you are in the right place. In this video, we are breaking down the basics of accounting and the terminology you need to understand it. By the end, you'll not only grasp these concepts but also feel ready to dive into the financial world with confidence. So, what exactly is accounting? In simple terms, accounting is the process of recording, summarizing, and analyzing financial transactions. It's how businesses keep track of what they own, what they owe, and what they earn. Think of it as the heartbeat of any organization. Without it, no business can survive for long. But here's where it gets interesting. Accounting isn't just about numbers. It's about telling a financial story. And to tell that story effectively, you need to understand the key terminology used in accounting. Now, let's dive into some essential accounting terms that every beginner needs to know. Accounting is often described as the language of business. It plays a vital role in any organization, whether large or small, by systematically recording, analyzing, and summarizing financial information. Through accounting, businesses can track their performance, make informed decisions, and report their financial status to stakeholders. Understanding accounting requires familiarity with its fundamental concepts and terminology. What is accounting? Accounting is the systematic process of identifying, recording, classifying, summarizing, and reporting financial transactions to provide an accurate picture of a business's financial position. It encompasses various activities, including bookkeeping, preparing financial statements, tax compliance, and auditing. The ultimate goal of accounting is to provide financial information that is useful for decision making. Types of accounting. Financial accounting. Financial accounting focuses on preparing financial statements like the income statement, balance sheet, and cash flow statement. These reports are used by external parties such as investors, regulators, and creditors to assess the company's financial health. Management accounting. This branch of accounting provides internal reports to management, helping them make informed operational decisions. It includes budgeting, forecasting, and various financial analyses tailored for business strategy. Cost accounting. Cost accounting deals with recording, analyzing, and reporting costs associated with producing goods or services. This type helps businesses control costs and determine pricing strategies. Tax accounting. Tax accounting focuses on complying with tax laws and regulations. It involves the preparation of tax returns and the planning of tax payments. Auditing. Auditing involves examining financial records to ensure their accuracy and compliance with accounting standards. External audits are often conducted by independent firms, while internal audits are performed by in-house teams. Importance of accounting. Decision-making. Accurate accounting helps businesses make strategic decisions regarding investments, expenses, and growth opportunities. Legal compliance. Proper accounting ensures that businesses comply with financial regulations and tax obligations. Performance evaluation. By analyzing financial statements, businesses can gauge their profitability, efficiency, and overall performance. Stakeholder communication. Accounting provides transparency, allowing stakeholders like investors, employees, and creditors to understand the business's financial condition. Key accounting terminology. Assets. Assets are resources owned by a business that have economic value. They can be classified as fixed assets, long-term assets such as buildings, machinery, and land. Current assets. Short-term assets that can be easily converted into cash, like inventory, accounts receivable, and cash itself. Liabilities. Liabilities are obligations or debts that a business owes to outsiders. They include current liabilities, short-term obligations like accounts payable, taxes payable, and short-term loans. Long-term liabilities, debts payable over a longer period, such as bonds payable and long-term loans. Equity. Equity represents the owner's interest in the business after all liabilities have been deducted from the total assets. In other words, equity equals assets liabilities. Revenue. Revenue is the income generated from the normal operations of a business, such as sales of goods or services. It is often referred to as the top line in financial statements. Expenses. Expenses are the costs incurred by a business in the process of earning revenue. They can be operating expenses, regular costs like rent, utilities, and salaries. Non-operating expenses, costs not related to core business operations, such as interest expenses. Profit and loss, gross profit, the difference between sales revenue and the cost of goods sold, COGS. Net profit, the remaining income after all expenses, taxes, and interest have been deducted from the total revenue. This is often referred to as the bottom line, loss. When expenses exceed revenue, the business incurs a loss. Debtors, money owed to the business by customers who have purchased goods or services on credit. AR is recorded as an asset because it represents future cash inflows. Creditors, money that the business owes to suppliers or vendors for goods and services purchased on credit. AP is classified as a liability. Depreciation, the gradual reduction in the value of a fixed asset over its useful life. Depreciation is an expense that is accounted for periodically to reflect wear and tear. Accrual basis accounting, under this method, revenues and expenses are recognized when they are incurred, not necessarily when cash is received or paid. This provides a more accurate picture of a business's financial condition. Cash flow. Cash flow refers to the movement of money in and out of a business. Positive cash flow indicates more cash coming in than going out, while negative cash flow suggests the opposite. Journal entries. These are the basic records of transactions. Each transaction is recorded as a journal entry that includes details like date, accounts affected, debit or credit amounts, and a brief description. Ledger. A ledger is a collection of accounts where all journal entries are posted. It categorizes transactions into various accounts like assets, liabilities, and expenses. Trial balance. A trial balance is a statement that lists all the general ledger accounts and their balances. It helps verify that total debits equal total credits, ensuring that the accounting books are balanced. Financial statements. Income statement shows revenue, expenses, and profit over a specific period. Balance sheet provides a snapshot of a company's assets, liabilities, and equity at a given point in time. Cash flow statement tracks the cash inflows and outflows from operating, investing, and financing activities. Conclusion. Accounting is the backbone of financial management in any organization. Understanding its principles and terminology is essential for anyone involved in business, whether they are owners, managers, or investors. With a grasp of these concepts, businesses can ensure accuracy in financial reporting, maintain regulatory compliance, and make informed decisions that drive growth and profitability. So, whether you are looking to start your own business, pursuing a career in finance, or just curious about the world of money, mastering these basic accounting terms is the first step. If you found this video helpful, make sure to hit that like button and subscribe for more beginner-friendly content. And remember, understanding the language of accounting is a superpower in today's world.